The money market model. The classical theory of inflation dictates that prices rise when the government prints too much money. And we have historical examples to support that theory. However, governments enact certain monetary policies to not only maintain price stability, but to also achieve full employment and economic growth. In comes the money market graph. The money market graph shows interest changes in the short run. Interest rates are powerful incentives that would determine whether investment and eventually economic growth will take place. Noted economist John Maynard Keynes theorized that an economy's interest rate is determined by the supply and demand for money. This theory is known as the theory of liquidity preference, and it is visualized in the money market graph. The interest rate is placed on the y-axis and the quantity of money is on the x-axis. The money supply curve is a vertical curve because the central bank determines the amount of money in an economy. The money demand curve is a downward sloping curve. When these two curves combine, it creates the equilibrium interest rate. The equilibrium interest rate is the market-determined price that borrowers pay for borrowing money over an extended period of time. Because the money market model shows a change in interest rates in the short run, the nominal interest rate is represented on the graph. Although the money supply curve is vertical, there are events that would shift the curve to the left or to the right. We have already established that the central bank determines the amount of money in an economy. Therefore, it is the actions of the central bank that would shift the money supply curve. This is done through monetary policy. A central bank can increase or decrease the money supply in three ways. The first is through open market operations, the sale and purchase of government bonds or securities. When the government buys bonds, the amount of money increases. The money supply curve shifts to the right and the equilibrium interest rate goes down. When the government sells bonds, the amount of money decreases. The money supply curve shifts to the left and the equilibrium interest rate increases. The second is through the reserve requirement placed on banks that are members in the Federal Reserve System. When the reserve requirement goes down, the money supply goes up and the curve shifts to the right. When the reserve requirement goes up, the money supply goes down and the curve shifts to the left. The third is through the discount rate or window. The interest rate or loans that a central bank charges to banks is known as the discount rate. If the discount rate goes down, the money supply goes up, shifting the curve to the right. If the discount rate goes up, then the money supply goes down, shifting the money supply to the left. The money demand curve shows a relationship between the quantity of money demanded and the interest rate. So if there is a change in the interest rate, then there would be a change in the quantity demanded. So if interest rates decrease, then the quantity of money demanded would increase because the price to pay for the use of money is low. If interest rates increase, then the quantity of money demanded would decrease because the price to pay for the use of money is high. Note, the interest rate does not affect the quantity of money supplied because the amount of money supplied is determined by the central bank. But back to the money demand curve. The money demand curve can also shift to the left or to the right in three ways. The first reason is the price level. When the price level goes up, the demand for money goes up. When overall goods and services cost more money is needed in order to pay for the goods and services. Therefore, the money demand curve shifts to the right, increasing the interest rate. In addition, the value of your money goes down. When the price level goes down, the demand for money also goes down, shifting the money demand curve to the left, decreasing the interest rate, and the value of your money goes up. The second reason is real gross domestic product or income. When real GDP or income goes up, then consumption goes up, meaning an increase in money demand, shifting to the right. If real GDP or income goes down, then the money demand curve shifts to the left. The third and final reason how the money demand curve can shift is through transaction costs. Transaction costs are the extra fees that are added to transactions. For example, if you have to get cash out of an ATM and the ATM does not belong to the bank that you normally do business with, you would pay a fee in order to receive the cash. Therefore, if transaction costs increase, then demand for money will increase due to the increased cost of obtaining the money. If transaction costs go down, then the demand for money goes down.